Most co-ownership agreements don't fail because of the mortgage. They break up over the dishes, or the cousin who showed up for a weekend and stayed 3 months, or the argument about whether to replace the HVAC now or wait. The legal side of co-ownership is actually the easy part. The living side, that's where it gets real. Today, I'm giving you the full picture, the deal, the documents, and the conversation you have before anyone sleeps under that roof. Co-buying is gaining real traction among Black millennial buyers in the DMV right now, and for good reason. The median home price in DC is around $630,000. On one income, that's a stretch. Split it with someone you trust, with both incomes on the mortgage, and the math starts working. But I've watched arrangements like this succeed, and I've watched them collapse. The difference is never the interest rates, it's always the agreement, both the legal one and the living one. Let me walk you through both. First, choose the right person. This is a business partnership before it's anything else. You need someone with stable income, aligned financial goals, and critically, the same exit timeline. 3 to 5 years is the sweet spot for most co-buying arrangements. If one person is thinking forever and the other is thinking starter situation, that misalignment will surface at the worst possible moment. Second, get the title structure right. There are two options. Tenancy in common lets one person own a defined percentage, 60-40 if the down payments aren't equal, for example. Each person's shares goes to their estate if they die. Joint tenancy means equal shares, and the surviving co-owner inherits automatically. Neither is wrong, but choosing the wrong one for your specific situation is a real mistake. Get a real estate attorney involved before you close, not after. Third, write a co-ownership agreement. This is the document most co-buyers skip. Don't. It needs to cover how decisions get made, how monthly expenses are split, what triggers a buyout, and how that buyout is valued. Is it based on an appraisal, the original purchase price plus appreciation? You decide that now, in writing, when everyone is calm, not when one person is ready to leave and the other isn't. Here's what the legal documents don't cover, and this is where most co-ownership arrangements actually live or die. Chores and maintenance. This sounds small until it isn't. Who handles yard? Who calls the plumber? Who buys the cleaning supplies and tracks what gets reimbursed? The answer isn't we'll figure it out. The answer is a written schedule, a shared household document for recurring expenses, and a clear understanding of who owns which responsibilities. Build it before you move in. Now, the maintenance savings plan. This one is non-negotiable. A home requires ongoing investment. HVAC, roof, appliances, plumbing. The standard rule is 1 to 2% of the purchase price per year set aside for maintenance. On a $630,000 home, that's $6,300 to $12,000 annually. Split between two owners, that's manageable. But you have to agree on the number, open a dedicated account, and both contribute to it monthly from day one. Decide in advance who has authority to approve repairs under a certain amount, say $500. Then that's without a joint decision. And what's the threshold for decisions that require both owners to sign off? Guests and extended stays. This is the one that catches people off guard. Your co-owner's sister comes for a week and stays a month. Your college friends needs a place while they look for an apartment. These situations will happen. The partnership gets sketchy when Cousin Clem has to have been sleeping on your couch for 3 weeks and is eating all your Wheaties. What's the rule? How long is a guest allowed to stay before it requires a conversation? Is there a cap? 2 weeks? 30 days? What about overnight guests on a regular basis? Write it down. Not because you don't trust each other, but because having the rule makes you never have to make it personal when you enforce it. Entertaining and use of common spaces. How often do you each host? Big gatherings, holiday parties, cookouts, birthdays? Do those require advance notice to the other owner? What about regular hosting? A standard poker night? A weekly dinner group? These aren't deal breakers, but they're friction if you haven't talked about them. The conversation is easy before you move in. It's hard at 11 p.m. the night before someone's event. Property upgrades and improvements. One of you wants to renovate the kitchen. The other is fine with what's there. Who decides? Who pays? And who captures the value when the home sells? Upgrades that increase property value should be documented. cost tracked, and the financial contribution factored into the equity split at exit. This matters especially if the improvements aren't split equally. If one person puts in $20,000 for a new kitchen and the other doesn't contribute, that should be reflected in the buyout calculation, in writing, in advance. Financial transparency in the shared account. Consider opening a joint operating account, especially for the property. Mortgage, insurance, taxes, utilities, maintenance savings. Everything runs through it. Each person contributes their share monthly. Nothing is ambiguous. Nothing requires awkward conversation about who paid for what. It's just the system, separated entirely from your personal finances. The best time to plan your exit is before you move in, not because the arrangement is going to fail, but because a clean exit plan is what makes the arrangement safe enough to commit to in the first place. Here's what a clean exit looks like. You agree on a trigger. Either party can initiate an exit after year 3 with 90 days notice. You agree on valuation. You order a new appraisal, average 2 if you disagree. You agree on first right of refusal. The co-owner gets the first opportunity to buy the other out before the property goes on the market. And you agree on what happens if neither can afford to buy the other out. You list the home, split the proceeds according to your ownership percentage, and move on. That's not a breakup plan, that's a business plan. And it's what protects your friendship, your credit, and your equity when life changes, because it will. I want to be direct about why this matters specifically for Black millennial buyers. Homeownership is a primary wealth-building vehicle in this country, and our community has faced documented barriers to accessing it. Appraisal bias, predatory lending, redlining's long tail. Co-buying isn't a workaround, it's a strategy. It's two people deciding to stop waiting for perfect conditions and build something real with what they actually have. I've seen it work. A 2-bedroom in Petworth, 2 friends, 3 years, and both of them walked away with $80,000 in equity each. That's not nothing, that's a down payment on the next chapter. Do it right, and it works. Co-ownership succeeds when it's structured well and lived intentionally. The legal agreement protects your investment. The living agreement protects your relationship. You need both. If you're seriously considering this, I'd love to walk you through it and see what it looks like for your specific situation in the DMV. Drop a comment, DM me, or book a call at speragroup.us. Of course, I actually have a sample co-living agreement. I'm Troy Patterson with the Spera Group, and that's how you find a friend and build real wealth. So now you know.